Now let's talk about time, because fear of giving back profits is also fear of time. The longer a trade stays open, the more uncertainty a trader feels. They want resolution, but markets resolve on their schedule, not yours. If you demand fast resolution, you will never capture slow expansion. Institutions are not in a rush. They operate on session flows, daily objectives, weekly narratives. Retail traders operate on minutes. That difference alone explains why profits look so different. Now, here is something most traders never consider. The market rarely gives maximum expansion to traders who enter late and exit early. It rewards those who enter with intent and exit with patience. Intent gets you in, patience gets you paid. Now let's connect this fear to overtrading. Traders who exit early feel unfulfilled. They feel like they almost had it. So they re-enter, they chase, they overtrade, all because they didn't allow the original trade to work. One premature exit often leads to 3 unnecessary trades. Now hear this carefully. If you want to grow as a trader, you must allow some trades to feel uncomfortable longer than you want. There is no shortcut around this. You cannot read your way out of it. You cannot indicator your way out of it. You cannot backtest your way out of it. You must sit. That sitting is what builds trust in your process. And without trust, no amount of knowledge matters. Now let's end this chapter with clarity. Fear of giving back profits is not solved by tighter rules. It is solved by bigger perspective. When you know where price is likely to go, short-term fluctuation loses its power over you. When you know the narrative, you stop reacting to noise. When you know your invalidation, you stop defending comfort. And when you stop defending comfort, you start capturing expansion. If entries get you into the game, exits decide whether you ever win it. Most traders think exits are simple. Take profit here, trail stop there, scale out somewhere in between. But that simplicity is exactly why their upside dies young. Exit structure is not about comfort. It is about intentional distribution. Professionals do not exit trades randomly. They exit based on where reactions are likely, not where profit feels sufficient. That distinction separates traders who grow from traders who stall. Let's dismantle the retail exit mindset first. Retail traders exit because of fear of giving back profits come. A green number that looks good enough, a candle that goes against them, a feeling that price has gone far be. None of those are valid reasons. Price does not care how far it is gone relative to your entry. It only cares about unfinished business. Unfinished business is liquidity. Now here's the first rule professionals understand. Exits are planned before entries. If you do not know where you want to distribute before you enter, you will exit emotionally. Every single time. Professionals know where liquidity pools sit before price reaches them. That means previous highs and lows, equal highs and lows, session ranges, higher time frame inefficiencies, weekly and daily reference points. Retail traders discover these levels after price reacts. That's already too late. Now let's talk about partials. Partials are not meant to reduce fear. They are meant to reduce exposure at reaction zones. Most traders misuse partials as emotional relief. They take partials the moment price moves in their favor, not because price reached the logical area, but because they want to feel safe. That safety costs them expansion. Professionals take partials only where opposing liquidity is likely to respond. That could be the first major pull, not a minor structure point, not a random pip target, a meaningful pull. If price has not reached meaningful liquidity, there is no reason to reduce size. Now let's talk about runners, because this is where most traders fail completely. A runner is not an afterthought. A runner is the entire point. The runner exists to capture the move that pays for everything else. If you structure your trade so that the runner has no room, no time, and no patience, then you are not trading professionally. You are scalping disguised as swing trading. Professionals protect runners with structure, not emotions. They do not trail stops aggressively. They allow price to breathe. Retail traders trail stops behind every candle because they want to lock profit. Locking profit kills runners. Now hear this clearly. The market rarely gives expansion in a straight line. It pulses, it breathes, it manipulates. If your runner cannot survive a normal pullback, it was never meant to run. That is not bad luck. That is bad planning. Now let's talk about invalidation versus profit protection. Retail traders move stops to break even or into profit too early. They believe this is discipline. It's not. It's fear management. Professional traders move stops only when structure has shifted in their favor. Now let's close this chapter with clarity. Exits are where discipline is tested. Entries feel exciting. Exits feel uncomfortable. The market pays discomfort. If you plan exits based on structure, liquidity, and narrative, you remove emotion from the equation. And when emotion is removed, expansion becomes possible. Every trader can enter a trade. Very few can stay. Staying is the final separator. Not strategy, not indicators, not entries. Staying. Scaling as a trader does not come from avoiding losses. It comes from allowing inevitable expansions to pay for everything else. This is where most traders collapse. They have the knowledge, they have the setups, they have the analysis, but they do not have the endurance. And markets do not reward intelligence alone. They reward emotional durability. Now, understand this clearly. Scaling is not linear. It is episodic. Months of nothing, then a few decisive expansions. Those expansions do not come to traders who exit early. They come to traders who remain aligned when others lose patience. Institutions are not consistently profitable every day. They are consistently positioned for large opportunities. Retail traders want daily validation. That need forces early exits. Now let's talk about the myth of consistency. Most traders misunderstand consistency. They believe consistency means small, steady wins. That belief destroys scalability. True consistency comes from process, not outcome. If your process allows winners to expand, your equity curve will be uneven but upward. If your process clips winners, your equity curve will look smooth until it collapses. Professionals accept uneven equity curves because they understand where money is made. Retail traders chase smoothness and never grow. Now let's talk about pressure, because this is where holding winners gets hard. When a trade runs, pressure increases. The profit and loss grows. The fear grows with it. The larger the unrealized profit, the louder the internal voice becomes. Just take it. Don't be greedy. You've made enough. That voice sounds responsible. It's not. It's fear pretending to be wisdom. Greed is not holding a winner according to plan. Greed is abandoning structure because you want more without logic. Professionals are not greedy. They are obedient to structure. They exit when structure breaks, not when fear rises. Now consider this. If you cannot emotionally handle large unrealized profit, you will sabotage success every time it approaches. That is not a technical issue. That is an identity issue. You must become the kind of person who can sit with success without self-destructing. That takes exposure. There is no shortcut. Now let's talk about size, because holding winners changes how you scale. Professionals do not increase size by trading more. They increase size by holding longer. One extended winner does more for account growth than 10 small wins. That is why professionals are selective. They do not waste emotional capital on low potential trades. Retail traders exhaust themselves with constant activity. Now hear this carefully. If you want to scale, you must stop thinking in terms of trades and start thinking in terms of campaigns. A campaign is a directional idea executed over time. Campaigns require patience. Campaigns require conviction. Campaigns require tolerance for fluctuation. Perfect entries are irrelevant in campaigns. Early exits destroy campaigns. Now let's bring everything together. Closing winners early comes from fear of loss, fear of success, fear of time, fear of uncertainty. All of those fears stem from one root: lack of trust in process. Trust is built only one way: by doing the hard thing repeatedly, by holding when you want to exit, by staying when you want resolution, by respecting structure when emotions scream. This is not motivational talk. This is conditioning. Now here's the final truth. The market does not pay traders for entering. It pays them for enduring. Enduring boredom, enduring pullbacks, enduring manipulation, enduring uncertainty. If you can endure, you scale. If you cannot, you cycle. And most traders cycle forever. So if there is one discipline you must master above all others, it is this: let winners work. Not because you hope, not because you dream, but because the market's design demands it. Hold until the market proves you wrong. Exit only when structure breaks, and let expansion do what it was always meant to do.